Oh, let's give. Hi, everyone. I'm Alan Moreira, and I'm an associate professor here at Simon. And today I want to, talk about, what's going on with, the financial sector in the U.S., in particular with banks. So I will, this talk, is going to give you like a framework to think about, how to think about banks and connect this what happened with Silicon Valley Bank and what might be happening now with the financial sector. So the starting point is to think about what is happening, is to ask the question, what exactly banks do? And the bulk of their debt is in the form of deposits that can be demanded at any time, right? What does demanded means? Means that, you park the money, in JP Morgan at any point in time, if you have, $100, $10,000 or $10 million, you can just like ask them and get this money immediately, like on demand. And then the bank, get this money that you give to them and invest in a mix of assets, short-term government securities, medium-term loans, and long-term government securities. They might invest in some riskier stuff here and in there, and in particular, during 2008, these risk investments were very important part of thinking about what happened during the great financial crisis. But today, the bulk of the aggregate balance sheet of banks is in fairly well understood assets, okay? Now, one key risk that these assets are exposed to are interest rate risk, right? If you have long-term loans or long-term bonds in your book, if interest rates rise, the prices of these assets will fall, even if they're gonna have a higher rate of return going forward. Now, banks, to have understand how much risk they're exposed to, but banks have $17 trillion in assets with a duration of about 4. What the duration means that if there's a 1% movement in interest rates, the asset will tend to lose 4% in value. Okay, so that's a big exposure. So what happened, in these last few years? So since early 2021, the Fed has been increasing interest rates, right? So in this plot here, you see the green path. That's the interest rate that basically the Fed sets, and you see has been climbing up. Now, these long-term rates have increased, quite dramatically. As the Fed increased rates from 0 to 5%, long-term rates increased by 2.5%. So, which is a very, very big move for a year. Now, so far, up to March, you look at this red line. That's the performance of the bank index. Okay, that's like aggregating all the banks in the U.S. and how they were performing relative to the broader market. And if they are above 0, means that they are overperforming the broad market. So even though everybody understood that, like the interest rates were going up, everybody understood that the banks had these very long-term assets in their books. Nevertheless, banks were doing just fine. And then you have here this red bar, you have the SVB crisis, and then suddenly, banks tank, okay? Now, and these losses to have a sense of like how big this interest rate increase can be for banks, banks lost just from this interest rate movement about $1.7 trillion in value, right? That is a 2.5% move in the interest rates times a duration of 4 times a $7 trillion balance sheet. That's comes to about like 1.7 trillion. So if you compare that with the equity that they have, that's about $2.2 trillion. So those are very large losses. And yet, the market didn't seem to care. So were investors asleep? But what was happening, right? So to understand why that happened, you really have to think about deposits. The key thing that the banks produce is deposits. Most depositors, you probably earn close to 1% in their account, maybe less, If you have a deposit in the JP Morgan, you still today earn 0% in your checking account. And you could earn 5% on an asset that is just as safe. You could invest in money market funds that pay something like close to 4.5% today. So this spread, this difference between this 1% average and the 5% is a lot of money for a balance sheet of aggregate balance sheet of $1.7 trillion. That's about $700 billion per year. So JP Morgan alone made $20 billion in just the first quarter of this year. So in this spread, you see here, it's very small when interest rates are zero, but goes up massively when interest rates rise. Means that the value of banking depositors goes up when interest rates are high, okay? And that's very important. You know, the value of being a bank that has a lot of deposits become more valuable when interest rates rise, right? And that is something that it does not show in the value of the assets, right? And that's why the market was not reacting to these drops, because they understood that as interest rises, they were losing money on the asset, but they were making more money out of the deposits. Now, the way that people call this in the industry is the deposit betas, right? The deposit betas measures how much the bank increased the deposit rate, the rate that they pay in your checking account, as the Fed moves the rates up. Across many monetary policy cycles through the years, this deposit beta has been about 0.2. That means that if the Fed hikes rates by 5%, bank only increases rates by 1%, roughly what we've seen so far in this cycle, right? So if these betas are below 1, the banks are going to milk more profits as the interest rates go up, right? Counterintuitively, this means that if banks want to be hedged with respect to interest rate risk, they should have a lot of long-term bonds, because these long-term bonds will do poorly when interest rates rise, offsetting the value of the deposit franchise. And conversely, if interest rates go down, the deposit franchise will make less value, but these assets will appreciate. Okay, and that's a big if these positions are chosen correctly, the future profits you make from depositors are exactly going to be offset by the losses you make on your loan bond portfolio. Now, another thing that's very important to think about banks is that they are fragile. Okay, this all works great if depositors behave reasonably close to what is expected. That is, if these deposit betas are stable. That is, if depositors are sleepy or sticky in the future, just as well as they were in the past, okay? The idea that they could demand their money, but they don't. And in practice, you can raise the rates much lower than the Fed does. Now, 3 types of things can go wrong here. One is correlated liquidity needs. Maybe all your depositors will need money for some reason at the same time. We're going to see that SVB, this was an important initiating event for SVB. Okay. A second thing is that maybe depositors have concerns about the safety of the deposits. And we're going to see that these 2 things interacted together for SVB. And the third thing that is the most concerning of them all for the overall banking system is that maybe competition for depositors will heat up, bringing these betas close to 1. Okay. So now let's go through these 3 things. Okay. So the first thing is that these depositors might all need their deposits at the same time, right? This is more likely to happen when depositor base is very undiversified. That was very common in the pre-national bank era, when you had all the banks were local. So any local economic shock, let's say farmers in Iowa, they would, like, if there's a drought or something, they need liquidity, they need their deposits. They try to take all their money out at the same time. Even if they are not concerned about the bank, but they need the cash, then the bank would fail, right? And people would run also because they see that the bank will fail because people are taking out the money. The Federal Reserve was created exactly as a way to solve that problem, to provide liquidity and loans for banks in this situation. But the assumption here is that the bank indeed has enough assets to back these deposits, right? They can pledge to the Fed some assets that the Fed can later sell to back the loan. This type of arrangement fails if the bulk of the bank value is coming from deposits themselves. A mother bank today makes a lot of money, not just from the assets that they hold, but the fact that they are going to earn a lot of money in the future from these depositors. But if they are leaving, now you cannot make that money, and therefore this solution will not work as well. Okay. That is, the Fed cannot lend against the deposit franchise value, since the reason that the bank needs money in the first place is because depositors are leaving. Okay. Now, a second concern, and they interact, is that depositors can become concerned about the safety of their deposits, right? When interest rates rise, more and more of the value of the bank comes from future profit it makes from depositors. Thus, if you're concerned others will leave, you'll be very likely to leave as well, because you know that the way that your bank stays solvent is that the depositors stick with it, and the banks are going to make profits going forward, and that's why they're going to be able to pay you back. But if you think people are going to leave, now they are not going to be able to pay you back, therefore you leave today. This means that the bank becomes increasingly fragile and exposed to self-fulfilling runs, even if their assets are completely liquid, because their most important asset, the depositor base, is not liquid. You cannot sell that easily. Federal Reserve lending might have an impact by providing liquidity if it makes deposits chill out. We don't understand why they would, but maybe a lot of policies about communicating and getting people to chill out. But the impact is very uncertain. And of course, the Fed can always cut funding down the line, and depositors might, walk away from the bank anyway. Now, deposit insurance can be very effective because it largely solves the problem, because it decouples depositor perceptions of the safety from what they think other depositors will do. So now you're breaking down this self-fulfilling panic aspect that can happen in these situations. Now, the third thing that can happen that would break down these deposit betas is that the competition can increase, pushing these betas closer to 1. For example, Apple just started last week, I believe. They started offering savings account that pays 4.15%. JP Morgan pays 0%, right? So now these new entrants can push these big banks, and certainly small banks, to have to increase the deposit rates, right? Now, because even if deposits overall stay in the system, because everybody has to pay more, the value of the deposit franchise gets erased, because everybody's paying closer to 5%, and now you are making much less money off your depositors, so the bank is less valuable, okay? Here, deposit insurance does nothing. If anything, it might even exacerbate the problem. It's going to make people more comfortable shopping around for rates because they think everything is insured. So it is, it can actually backfire. Now, even if banks were not insolvent and depositors were not concerned about their safety, an increase in competition can trigger these concerns, exactly because the value of the bank comes a lot of these future profits. If now suddenly competition increases, these future profits are going to be lower, meaning that now the bank is in higher risk of being insolvent. Now, what's going on right now? So, which is the important, which of these three things are happening? Now, I think to think about that is useful to first, zoom in on SVB, okay? And that's what we are gonna do. So, Silicon Valley Bank served mostly the venture capital and startup community in Silicon Valley and in other places, but a very special community, of founders and people connected to the startup scene. They competed aggressively for these depositors by offering all sorts of sweet deals on credit lines and mortgages, right? It's not that they were getting, passively overrun with deposits. They were like, aggressively getting these depositors because they bet that they would stick around as interest rates rise. Now, one thing that's very special about SVB is that 97% of these deposits were very large and didn't qualify for deposit insurance. And what happened in 2022 as Fed started tightening interest rates? Funding for startups dried up. No IPOs, no founding rounds. Bank clients steadily consumed their deposits. That is, the bank won. Why? SVB have a very undiversified consumer base. They're all founders and VCs. They are all exposed to the same risk. The risk that the IPO market, the funding market shuts down. And that's what happened in 2002. So they had a very large outflow of deposits. Nothing related to interest rates. They were not shopping for interest rates, but they just needed the money and they cash out. In aggregate, there was just a 3% outflow from banks, but for SVB it was 11%, so fourfold higher than what we saw in aggregate. Now, it was public known that SVB, as many other banks, had very long-term assets, but they thought their clients were these low beta clients, right? These clients that are insensitive to rates, which they are. Startup founders, VCs, they don't shop for rates. But they forgot that cash flow for startup typically dry up as interest rates rise. Even if they're not shopping for rates, they get less money. They need to consume, they need to eat, they need to, buy their, nice cars. And then in the end, what happens is that the deposits get withdrawn, right? Now, when this was announced, right, that they had this large outflows. Think about these 3 bars in this plot. That's the outflows that they announced in this famous March 8 announcement. Then a frenzy across the board in a very closely connected community started when people started communicating, look, this bank might be in trouble. And immediately in the next day, when, in the market opening, it opened at minus 73%, the equity of SVB. And that obviously validated people's concerns. And then immediately people started withdrawing, and roughly one third of the deposits tried to leave the bank within a day, right? So problem 1, the correlated liquidity shocks end up creating problem 2. Okay, and then FDIC had no other solution than to take over the bank before it opened on Friday. Now, on Sunday, they seized another bank, that also had a very correlated, undiversified depositor base. Same story, really, but more focused on crypto than Silicon Valley people. Now, what was the policy response? They did 2 things. One, they expand the liquidity provision to banks, basically some easing of the terms that they can convert cash assets into cash. That's very like a 2008 solution. It can work great if the problem is that the assets are illiquid, but that's not what's at stake here, right? The problem is that these assets, the value of the bank franchise might have just evaporated for some banks. Now, the second thing that they did is that they announced deposit insurance for all depositors of the banks that failed during that weekend, right? De facto, it's not insurance because it's exposed, right? They said, look, you guys can chill out. It's all fine. You guys are going to get money. Now, they did not guarantee the deposits of any other bank, but suggested they could do the same if they thought these failures created systemic risk for the system. I think it's clear that there is no case to be made that SVB or Silicon Valley or crypto people losing money is a systematic problem per se, right? Like it, if AIG failed, the American Insurance Group failed in 2008, that would have been a systemic problem for the system. So there was good rationale for the Fed to bail out AIG. Here, there's no direct case for it because, Silicon, there's no follow-on failures that you would anticipate from this. But why they did it because they fear contagion, not through directly the losses of SVB, but because depositors in other banks would start getting concerned that their deposits were unsafe too, okay? And then the most plausible explanation here is that they saw a gigantic wave of outflows outflows of deposits from a variety of banks. Because it's unclear that they have legal authority to explicitly extend insurance to all the other banks, what they end up doing is they insure the failed banks, and winked, suggested that they would also, insure other banks, right? It's counterintuitive here, but bailing out bank A, the bank that fails, does nothing for us. What can help stabilize the system is promising to bail out the depositors of the banks that didn't yet fail. But because there is uncertainty, legal uncertainty about whether the FDIC and the Treasury can actually do that, then they end up doing things on a case-by-case basis. Saving this depositors in this bank, and implicitly promising that they would save depositors in future failures as well. Okay, so I think they were between two difficult positions, because they couldn't implement a better policy, that is to let Silicon Valley crypto depositors to lose money while saving the broader system. Now, were these fears justified? I mean, broadly, I would say yes. You see here that massive outflows from small banks following the March event. You see massive inflows into money market funds, and you see that even large banks like Charles Schwab and State Street are suffering a lot of outflows. Okay, so let me jump to the bottom line, because I think I run out of time. So so let me discuss what will happen going forward, because I think it's important. So it really depends on what factor will be the main driver. Okay, these three things. If the concern is with the safety of individual banks these times are fairly transparent, and regulators learn a lot from 2008. Right, even if some banks fail, the movement might be most across banks and not driven by rate shopping. This means that in aggregate, banks are going to stay similarly valuable. Any schemes that tax all banks to pay for individual bank losses, which is the current system, that can work. Okay, that is, if the money is just going from small banks to JP Morgan and Wells Fargo, that's fine, because you can always tax JP Morgan and Wells Fargo to finance the losses of the small banks. Now, if it's mostly about an increased competition, that is, depositors now waking up to the fact that they're earning 0% when they could earn 4%, then it's a problem that's much harder to deal with, right? Because that can wipe out the value of deposits in aggregate. Taxing banks to pay now doesn't really work, because all the banks are going to be less profitable. And during many rate cycles in the past, we didn't see this widespread awakening of depositors, right? So people have seen that multiple times, and it didn't happen. So, but it can always be different, right? Maybe the speed of the monetary policy tightening was different this time. Maybe now fintech, maybe the ease of moving, much easier to move money across accounts. And maybe the social nature of the information environment, where people can tweet and coordinate, will make this deposit betas change more. We don't know. That's the key concern going forward. So the bottom line is that the policymakers should regulate financial entities on behavior, not description, right? These depositors in SVB were depositors in name only, right? They were very undiversified, and they were very large deposits that behave as wholesale funding, and they shouldn't be investing in assets as they were investing if those were regular deposits. And if you think narrowly, that was the key issue that plagued SVB. There was a mismatch between the fund and the assets, because they didn't have a standard deposit franchise. They had very particular deposits that were very correlated and very jumpy, and went out in the first time of trouble. Now, the key concern, that's the important thing, is that maybe the SVB failure and all the new coverages of banks might wake up depositors during a period when banks are particularly reliant on them staying asleep. And if that happens, that can create broader problems for the financial system. So there are many unanswered questions, and maybe we can go over those during the Q&A. Let me, but thank you so much. So I guess let me go over the Q&A here. So let's start with Barry here. When our recent PBS issues in part result of 2007 temporary fix that has not been removed. What merits are there in conclusion? If true, what means the life for other banks? Yeah, I mean, I look, regulation. We don't. I think we should be simultaneously highly critical of regulators and understanding of how difficult it is. We can't draw the financial system from the beginning. What we like, a doctor, what he does is like patches things as your body breaks down, and he can't like redesign your body as they wish, right? And potentially could reorganize the whole financial system. In practice, what regulators or policymakers, what people try to do through many political pressures is to try to fix different things. My understanding is that I don't see like in the end you can always label that as like some fixes that people do, but I think regulations are constant interactive process where you fix something, then you learn something about how the system works, and then you try to improve going forward. I think like the Dodd-Frank Act and other things that come out after, improved a lot. The banks are substantially safer today than they were, in 2007. I think there's no questions about it. So, but yeah, things are imperfect. Now, Ellie has what's the optimal ratio between short-term, medium, long for a bank? Is there a duration associated with health banks? That's an amazing question, Ellie, and that's a very hard question to answer, right? I think the important thing is that it has to be driven by the characteristic of your depositor base. I think that's one thing that we learned well from 2008. I have work on this. I know, really good work on this stuff. That is, we name things deposits, but if a deposit is money by retirees that consume at a very like predictable pace, that are not like particularly wired into the social media, then that deposit is going to behave very different if it's money from like a large institutional investor that's looking for rates and trying to like move, looking for advantages. And it's going to matter a lot what your depositor base is. If it's more like, some sticky retiree that, stick with the bank, then, you can have more long-term assets. You should have more long-term assets because you have to finance these branches and so on and so forth, even when interest rates are low. So you need to have assets that compensate for the fact that you're going to have, if interest rates go down, you're going to make less money for the deposit franchise. Now, if a depositor base look more like SVB, then you should have very short-term assets. So it really depends of what the client base. And this is not an academic thing. If you read like, earnings calls by people that know what they're doing, for example, Jamie Dimon, JP Morgan, the key thing that they think about is what are deposit betas of my clients. And that should shape how they invest in their assets, okay? So that's a question that like academics can put structure to think about, but in the end, it's a business call. That's important. You have to think about how your depositors are going to behave. And you're going to have models of that, but you have to acknowledge that the world is imperfect and you're never going to, nail it. Now, what is the right level of deposit insurance? That's a great question. And I think so far we thought that we could get away with having a limit of 250 and letting the others uninsured. But I'm not sure that's stable anymore because it seems that if things are called deposits, in the end of the day, regulators are going to be concerned that if these deposits lose money, other depositors, even the insured ones, might feel that they are at risk. And if that happens, the financial system is in big trouble. So And I understand this. It's a reasonable thing. It's often hard to explain to people like, oh, if you do spread your money, and people sometimes don't think that way. They have doubts about if the insurance is going to work. And they see that depositors are losing money, they might pull out anyways. So I think there is a question. Maybe what you have to do is like outlaw uninsured deposits, and have, if the bank wants to issue something that's like deposit-like in terms of like short-term funding, they would have different name and would be treated very differently. I think that might be a potential outcome of what we saw. In particular, the fact that policymakers felt the need to bail out SVB uninsured depositors. Now, Natasha has a question. What are the precautions that SVB could take to avoid the situation? What could have been a good alternate mix that could have held the long-term, have held instead of long-term bonds to support themselves in case of bank run? Do you think that's more localized, or do you think we'll start seeing more cases like across the economy of a more as more of the tightening flows through? Yeah, great question. I think everything, details matter, right? So we should I don't want to pretend that I really understand all the business decisions that the SVB have been, but if you look from bird's eye view, what SVB was doing, they were paying handsomely for these depositors in 2020, 2021. They were doing that by going to executives, SVB people, say like, look, move my money, your money here, of your account, of all your firms here, and I'll give you like a really nice credit line with a very aggressive spread on it, and people were like, oh my God, I'll move it. I'll give you a very sweet mortgage on your new house, and then people would move the money. So they were paying for these depositors. You probably got, JP Morgan, check in the mail saying like, oh, move your deposits here and you get $200 in your account, right? Banks do that, but they were doing that at a much larger scale, much larger sums. And in particular, what JP Morgan does, where Bank of America does, they shop for the small retailer, things that are sticky. What these guys do is they paid for deposits that are not sticky. It's like, it was a bad call. They didn't understand that they were getting a very undiversified base. And they invested as they had depositors like JP Morgan does, but they don't. So it was a mixture of like bad understanding of what they were getting for the marketing budget, all the sweet deals they were giving, and a bad risk management decision of like that's related to that. They're thinking they're getting these sticky depositors, they don't, and they're investing as they were. Now, I think there's two answers. They should not have paid for depositors that are sticky, not sticky. Given that they paid, they should have, thought, well, this deposit are actually not sticky. We got a raw deal, so they should invest in much short-term assets. That as interest rates rise, these assets wouldn't lose as much in value, and they would be fine. But they invested as JP Morgan, Bank of America do, that got caused them trouble. Now, Sherry, there is no reason to invest in banks because this is a very crazy structure. They are leveraged around 8 times their equity, and as long as the Fed fund rate is around 4%, this social gain will reduce their net interest margin. What are your thoughts on the long-term investment in banks? Look, there's two different things. Like trading, right? Whether we should trade, are they undervalued, overvalued? I mean, this is like the market, there's a lot of people that are putting their money at stake and thinking about these decisions, right? And the prices are reflecting a lot of that, right? So I don't want to like give investment advice here, whether banks are undervalued or overvalued. What I would say is that it's important. Banks milk more, if things in the typical cycle, if depositors behave as they typically do, banks make a lot of money when interest rates go up, right? Because net interest margin actually, go up, right? Just look at how much JP Morgan, the earnings that JP Morgan announced this quarter, Citibank as well. Like they make a lot of money during this period, right? The assets drop in value. right? But this typically offsets each other, showing exactly that plot. The equity tend to be like insensitive to these interest rates rise. Now, the concern is that if depositors suddenly awake, then, and that's the big question, we don't know how broad that is, how permanent that will be. But if that turns out to be permanent, then yes, then banks will be in trouble. But, the equity markets likely, reflect some expectations of these different events happening. And I don't pretend to say that they get exactly the probabilities right. I mean, that's a very hard question. And I don't think anybody can really answer. What you can do is like make, you can take bets on it if you're confident enough. Okay. But yeah, thank you. Those are amazing questions. Thank you very much for participating. And have a good one. Have a good rest of your week.